Should you pay off your mortgage faster, or is it smarter to just stick to the minimum and let the years roll on? I get asked this all the time, and my answer is simple. For your own home, there's pretty much never a bad reason to pay it off sooner. The only question is how you do it and how you keep yourself disciplined when life tempts you to take your foot off the gas. If you want to save up to 10 years on your home loan, build wealth, and give yourself more options down the line, here's 7 ways to actually make it happen. Step 1, make extra repayments. Pay weekly, pay fortnightly. Frequency and small amounts matter more than most people realize. Every extra $20, $50, $100 a week takes thousands off your total interest bill. Paying weekly or fortnightly instead of monthly, for every 12 years, you've wiped a whole year's worth of repayments. Just want to go into a little example as to how we're able to help you knock years off your mortgage with just an additional $150 off your mortgage. The average owner-occupier home loan in Australia is $666,000. So what we are going to do is we're going to average the current interest rates at 5.99. Your mortgage repayment will be $3,989. This is on the basis of a 30-year loan. So what we're going to do here is we're going to assume that there's another 2 rate drops. At a 0.25 per rate drop, you're going to potentially save up to 50, in banking terms, basis points. That's 0.5%. So if we take your current repayment of $3,989, and we reduce that down to the assumptive of 2 rate decreases over the course of 6 odd months, that's going to take us down to 5.49, which in essence is going to reduce your repayment to $377. Now we're plodding along making the same repayment. We've already committed to the higher amount. So what I would suggest and recommend is that $106 a fortnight, which would be your $212 saving, we would then recommend you make that repayment in addition to the rate drop. That will essentially save 3 years and 10 months off your mortgage. Step 2, most people drop their repayment when the minimum drops. If you keep paying the old amount, that extra goes straight onto the principal. Over 2 years, the additional $3,500 in repayments that you continually maintain will help you save interest in the years to come. Step 3, use an offset account or multiple offset accounts. Where you park your cash matters more than you think. Every dollar in your offset saves you interest at your loan rate tax-free. Have your salary go straight into the offset, even if you pull it out for bills. Families can set up multiple offsets, one for each kid or for different savings goals. We had a client in the process of refinancing who was hesitant to move her kids' funds into the bank she was refinancing to, as she's seen that as her kids' money. This particular lender allowed her to have multiple offset accounts, and that allowed her to save a lot of interest. So what we essentially did was we got her to set up an offset account on her home loan, move the funds that were over, which were in excess of $50,000, and that allowed her to save an extra $256 on her mortgage every month. Step 4, redraw versus offset. Pick what keeps you disciplined. Sometimes the right strategy is the one you're less likely to mess up. Redraw lets you access extra repayments, but you have to go into your loan to get it. So you're less likely to dip in. Personally, I use redraw because it keeps me honest. I'm less tempted to touch the money. Offset or redraw, it's about which works for your habits. Step 5, revolving line of credit. This might be classified as old school, but I have many clients who are really successful with this strategy. Salary goes into the loan, spend on a credit card, and pay the card off monthly from the loan. This maximizes the days your money sits against the principal compounding your savings. Just as an example, if you're paid $8,000 in salary and spend $2,000, recycling it through the loan could save you $24,000 if you stick to the system. Just as another example, a revolving line of credit. The way it works is you have your loan, and we're going to average that at $4,000 per month. We're then going to have your credit card as an example, and yes, you may not spend this, you're going to spend a lot more, but we'll just say $2,000 limit. Then we're going to have your salary. And your salary is $8,000 per month. So what we then do is we have your salary crediting your loan on, call it a monthly basis. If it's fortnightly, then fortnightly. What you're doing is you're spending groceries, your bills on the credit card. So your credit card ends up the $2,000. At the end of the month, your mortgage repayment of $4,000 comes out. Remembering you've already got $8,000 sitting in there. So the $8,000, the repayment comes out at $4,000. That takes your redraw amount to $4,000. Then essentially what occurs is the credit card goes, excuse me, you owe me $2,000, Mr. Redraw. So Redraw comes in and goes, right, we're sending you $2,000 to here and your limit stays $2,000, but your balance goes to zero. What you've essentially done is we minus another $2,000 from there for the credit card. What you've essentially done is you've paid an additional $2,000 off your mortgage. Now, if we multiply that by 12, that gives you an average of $24,000 that you've paid off your mortgage per year. Step 6, don't rush to pay off low interest debts like HECS. Not all debt is created equal. HECS or HELP is indexation only, no real interest, so it's smarter to focus on your mortgage where every dollar is costing you daily. Only pay off HECS early if it's holding back your borrowing power. Once you've paid your loan down, you'll have more equity to invest with. So why wouldn't you consider these kinds of strategies that don't require much input from you or major lifestyle changes to make a big difference? You're probably doing it anyway and not even realizing. Hopefully that helped. See you in the next one. Thank you for tuning in. You can follow us on TikTok, Instagram, Facebook, YouTube, LinkedIn, and all major streaming platforms such as Spotify and Apple Music. Links are in the bio. Everything mentioned on the podcast is general information only and not to be taken as financial, tax, or legal advice. Always consult a professional as everyone's individual circumstances are different.